What's up, shipmates? When a naval vessel is attacked, the crew goes to General Quarters, or GQ for short. Now, the point of that is to optimize the ship for battle readiness on both offense and defense. So all hands will go to where they're needed most to help defend the ship in almost every conceivable scenario. I was thinking about it, our portfolios are kind of the same, that they're only going to be as good as the sum of their parts. And any weak component can jeopardize the safety and survivability of our very own financial battleships. Take Intel for example, because last fall they cut their dividend. That was a clear sign of a struggling business that wasn't functioning properly. We recognized it as a broken part of our battleship that needed to be replaced, so we sold it, and we're better off for it because Intel just announced that they are totally suspending their dividend. Then there's AT&T, which was once a telecom giant and it had been showing signs of weakness for years, and in July we made the tough but necessary decision to sell. It wasn't easy, but it was crucial for maintaining the integrity of our portfolio. Now, having Intel and AT&T as a part of an ETF or a fund that's made up of hundreds of stocks is like a watertight compartment that's being flooded from a direct hit. The ship is going to sink a little bit below the waterline, but it's not going to be sunk. And to be seaworthy for many years, a naval vessel must have the best design, materials, craftsmanship, and crew. And the same goes for your portfolio. It pretty much requires constant vigilance and a willingness to make difficult decisions. And one thing I've learned from the years I've been doing this is I'm a dividend growth investor, so if a company cuts their dividend for anything other than a crazy black swan pandemic, it's time to sell and sell quick, because most companies that cut their dividend, it's a sure sign that something is wrong with the business. So I ask you, dear dividend investing viewer, what stocks in your portfolio are the weak links that might compromise your financial battleship seaworthiness? Now, if you find this information useful at any point during the video, feel free to give a thumbs up and hit the subscribe button. Now, I don't know if I'm supposed to be doing this, but check this out. On Seeking Alpha, there are groups. There's investing groups, and they cost an extra amount. But one of the groups I'm subscribed to, the Dividend Freedom Tribe, is a father and son team, Robert and Sam Kovacs, where they give some pretty good research, and I'm going to show you their monthly portfolio transaction, a little bit of a taste, where they're going to give you a market rundown. And oh, look at that. They happen to recommend Nexstar Media Group, which is one of our top holdings. They might come after me and kick me out of the tribe, but here's some of their buys. Don't tell them that I told you about this. And some of their sells. Also, don't tell Mr. Ryan Williams that they sold their last 4 shares of Williams Sonoma. So if you'd like 20% off of that and a 2-week free trial to check things out, click my affiliate link in the description below. And I also have my own very free weekly newsletter, which you can also sign up in the notes below. One raise this month, which was Enterprise Products Partners, ticker EPD. They hiked that dividend 1.9%. That's their 25th consecutive raise. That gave us an extra $7 of PADI, projected annual dividend income. And I think they might be the best midstream energy company, which pretty much means that EPD processes, transports, and stores oil and natural gas. So they allow other companies to use their pipes in their ships. So in the month of July, I received $70.14 from Vici Properties, ticker VICI. $36.75 from Main Street Capital, ticker MAIN. $18.25 from Agree Realty, ticker ADC. You get your O face on with realty income. We rolled up $52.60. Some people call this the holy grail of dividend ETFs is SCHD, the Schwab US Dividend Equity ETF, which paid us $133.50. And also from the Schwab family, we have SCHG, the Schwab US Large Cap Growth ETF, which hammered us with a huge $1.60 of dividend income. Innovative Industrial Properties, ticker IIPR, paid us $19. Toronto Dominion Bank, ticker ticker TD from the land of the Great White North paid us $117.59. With all that dividend income and option income, we received $865.44 of dividends. Now, we had some sells to finance the buys that you're about to hear, which were 150 shares of AT&T, ticker T, at an average cost of $18.83. And again, weakness, I don't like the telecoms. Total return over the last 10 years is very, very low, less than 40%. So yeah, it's just not something I want to be involved in. They always have something to spend money on. Highly capital intensive business, highly competitive, just not for me, and I've realized my mistake, and we completely exited out of AT&T. Now, we've also tidied up some other positions. LyondellBasell, in 2010, 2011, they filed for Chapter 11 bankruptcy, so this is what came out of that. But we sold our 15 shares at an average cost of $94.60, and our cost basis was in the mid-70s, so we made a few bucks on that, but I just wanted to put that into something that I feel has better overall total return potential. And then in the Roth portfolio, don't freak out, but we sold 10 shares of Johnson & Johnson at an average price of $152.48. Yeah, if I were psychic, of course, I would have waited a little bit longer, but we have 113 shares or so in the taxable account, and I wanted more Visa. I wanted more exposure to that beautiful company as it was dropping into the low 250s. So I just rolled J&J into Visa, and that's why we sold those shares. And now on to the buys. In July, we bought 19 shares of Nike, ticker NKE, at $74.94 average. Now, I think that brand is just iconic. They're miles ahead of their second place closest company, which is Adidas, or as my friends in Europe say, Adidas. And then similar to Nike, we've got a well-known brand that's been in a bit of a tailspin was Starbucks, ticker SBUX. And we bought 14 shares, average $75.13. Yeah, Starbucks, their sales, their foot traffic has kind of been down. China's throwing a monkey wrench into things, but I think they're going to figure it out. And all it's going to take, I'm telling you, all it's going to take is 1 or 2 solid quarters for everyone to forget how much they hate about Starbucks and that they're going to be heading to bankruptcy and all this. So I'm using this to accumulate shares at what I think is a good price, and I would hope that it would get into the lower 60s, mid 60s. I'll definitely be buying more there too. We bought 9 shares of Visa at an average cost of $259.45. Visa is just one of those gigantic and beautiful companies that has a duopoly with MasterCard. Remember, they don't issue credit cards. They don't have any credit risk. All that they do is process the payments. They have an incredibly big system all over the world. So I've been building up that position, tired of waiting for a pullback. And check this out at companiesmarketcap.com. Look at their price to earnings. That's how much you're paying for every $1 of their earnings. Currently, they're at 31.9, which sounds really high, right? But look at that line. They just are constantly around the mid to low 30s. And the last time it was below 20, right? People always have this number in their head saying, yeah, I like to buy stuff when it's at 15 to 20. Well, not with Visa. You're just going to have to pay up for quality because it has not been below a PE of 20 since March of 2012. And if it should happen to fall, I'm going to buy more. And we bought 1 little old share of SCHD, everyone's favorite dividend ETF. Don't tell the people that own VIG, at $76.75. This REIT has just shot up like a bat out of hell. Everybody's expecting the interest rates to come down. That's going to be favorable for the REITs. So people are piling now back into REITs, and it's really driving up the price. And I was well on my way to 100 shares, but added 16 shares in the month of July at an average cost of $63.74. And then keeping with the REIT theme, they've also done very well in the month of July is Vici Properties, ticker VICI. Now, they get about 45% of their base rent from Las Vegas. They're one of the biggest landlords on the Strip. And Harry Reid Airport out there had a record-setting month in June of 2024 for travelers. So people are coming into Vegas, but we grabbed 30 shares of Vici Properties at an average cost of $28.28, and it's well over $31 a share as of this recording. Now, if for some reason you're bored out of your mind, there's a link in the description below to this spreadsheet, but after all is said and done, the projected annual dividend income gain was $179. The loss was almost $300 for a net July patty of negative $117. But we feel that we rolled that money into companies that have a better total overall return potential. All right, now these are the three portfolios that we share on the channel. Our dividend yield, 3.97, yield on cost, 4.62%. And again, this is not everything that we own. We have a sizable chunk in a 401k through my employer. Now, this is on simplysafedividends.com. If we sort percentage of portfolio, we got Nexstar at the top with 11.9, 114 shares, 113 shares of J&J. Pause the video if you want to take a peek at some more of these numbers in depth. 100 shares of PepsiCo. We're up 18.4% on those. That's not with dividends included. It would be much higher. 163 shares of SCHD. Those are in a Roth. And remember, what you're looking at here is the combination of the three portfolios. 200 shares of Realty Income. 157 shares of Toronto Dominion, which were down about 10% on those. 405 shares of Ares Capital, giving us $777 of patty. 150 shares Main Street Capital, which has just been doing well, but it's pulled back a little bit. 25 shares of Visa. This will be at 100 someday, but it's going to be a slow growth to get up to that. Agree Realty, there it is, 92 shares. We want to get to 100. 200 of Vici. 74 shares of Starbucks. Again, I think Starbucks and Nike, they have really good profitability margins. They're both in a bit of a funk right now, but I think that they are strong enough to pull out of it. Lockheed Martin has just been on a tear, and we're up 63% on our 10 little old shares of Lockheed Martin. ExxonMobil up 159% only. You know, haven't really added to them. We bought those during the pandemic, so that's kind of crazy that they dropped all the way down to where we bought them at $45 and some even in the $30 range. 175 shares of Enterprise Products Partners, 25 shares of AbbVie, which has been going bonkers lately. 119% gain on those. The one non-dividend paying stock, Harrow Incorporated, ticker HROW, 177 shares. Hey, we're up almost 50%. 32 shares of Prudential at $110. They've pulled back a little bit, but still, we're up 45%. 10 shares of McDonald's. Thought we might start adding more if I was going to see it in the 230s, 220s, but it just did not get there. A lot of investors moving into the defensive names right now. 33 shares of Nike, which were down 2%, you know, kind of flattish like a radish there. 15 shares of Chevron. 15 shares of SCHG. This one I'm considering, because it's in the Roth, of just selling it and putting it into more Visa. And the thought was that I wanted more tech exposure, but with my 401k, there's a lot of overlap with the Magnificent Seven and those. And then Innovative Industrial Properties, IIPR, 10 shares. We're kind of waiting for that one to get up a little bit more, and then we likely will sell out of that. Now, hey, in this floating little box next to my head, if you want to have a little bit of fun, back in March, I put out this 10 great cheap dividend growth stocks that you need to know. So see how they've done. Have a laugh. Did I pick any losers? Any ones that have done well? If you click this floating little box next to my head, I will tell you all about them there.